Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
If you're interested in learning more about setting up your own family banking system, send an email to thefamilybankingshow@gmail.com. We'd love to hear from you.
Welcome back, ladies and gentlemen, to the Family Banking Show. We are your hosts, Derek, Rob, and John. Guys, how are we doing this week?
Good. How are you guys?
I was gonna say I'm reading this book. It's called Good Energy. Have y'all ever heard of it?
Uh-uh.
I'm like immediately wanting to share about it, just with how interesting it is. It's from an author named Casey Means. She's a former Stanford, doctor.
I know of her.
Now kind of in the space of, I think she's like the Surgeon General nominee or something.
Yep.
Anyway, aside from any, misconceptions or anything, like it is a really, really like interesting, good quality book to learn. And now I'm all kind of like obsessed with like tracking different health metrics and food intake and all, the total package there. So I've been nerding out on that over the last couple of weeks. So that's what's new with me.
Yeah. Another book added to the library, I guess.
I was gonna say we got a bunch of family coming over this weekend, so that'll be a lot of fun as summer is starting to wind down.
Yeah.
And get the nephews over and grandparents and parents, and so be a lot of fun.
The back to school shopping and all the fall activity registrations are starting to kick in. So yeah, it's kind of a sad time during the summer where it's like, oh, we know this is coming to an end soon, especially in Minnesota. So, all right.
Yep.
Hey, guys, we are talking about some different savings and financing strategies today. We're going to take a look at the Truth Concepts Calculator to figure out what is the best way to purchase vehicles throughout your life. Rob, I'm going to hand it right over to you so you can share your screen. If you are listening to us in the podcast format, the rest of this episode is going to be visual. You may want to check us out on YouTube this week so you can see kind of the behind the scenes of the math. How does this work? How does infinite banking or family banking beat other means of finance? So Rob, kick us off.
Yeah, I was also saying, calling it the infinite banking process proven was like my catchy line to like grab people's attention. And so what you're seeing here is this is a calculator, Truth Concepts Calculator, Todd Langford and his team. It's called the Borrowing Strategy Calculator. And what it's really good at is just showing the impact, the impact of kind of like taxes over time or saving over time. And what I'll do is I'll start it as I was working through, I've been spending a lot of time in this calculator and a lot of all of his calculators, just trying to understand them and get more familiar with them. And as I was going through it and going through different scenarios, it kind of like a light bulb moment happened, and it was like, this really just proves out what Nelson Nash meant when he said, "Don't steal the peas." And the infinite banking process, versus a product. Like we talk a lot about, early cash value, dividend paying whole life insurance as a product, but the process around it. The product is one piece of the puzzle because there are more efficient products to conduct the process of infinite banking. And early cash value whole life insurance is, in our opinion, the most efficient product to do infinite banking with. But if you just follow Nelson's rule of don't steal the peas, what I hope to show you is that it doesn't matter if you are in a coffee can or a savings account or using the cash value of your, or borrowing against the cash value of your whole life policy, just by not stealing the peas, you will come out ahead. And so that's what I hope to show you here. So what we're going to model is you're saving $10,000 a year. And in this case, I call it the coffee can. We're putting $10,000 a year into a coffee can. And what will we have at the end of that time frame? We got present value. Oh, sorry. Present value is 0. Annual payment is 10,000. You have 300,000 after 30 years. So I'll just put that in there to track our progress. But the reality is we're not putting our money in a coffee can, right? We're putting it into a savings account. We're putting it into a savings account with a rate of return as high as we possibly can get. And what I always do when I model typical high yield savings accounts, I just go to my go-to bank. It's called PenFed. They have really good rates. They have really good products. And right now you can get a premium savings account from them at 2.8%. And I know you can get higher than that somewhere else. But what I was trying to model is just what everyday mom and pop, can do to go get a high yield savings account easily, without having to jump through a lot of hoops, without having to have a lot of money down. It's just a really high quality, high yield savings account. And 2.8 is good. And then you'll see at 30 years, you have 473, 533. But you need to remember when you have your dollars in a savings account, you have to pay taxes. So we need to make sure we include the taxes. And I'm modeling a 30% tax bracket. So at the end of 30 years, putting your money in a taxable savings account at 2.8%, you will have $411,000 after 30 years. So that's an improvement, right? That's better than the coffee can. So that's what you'd want to do.
Better than my
But now we
savings
want,
account.
yep, better than my savings account, actually. Well, I do have the same savings account, so I'm getting that. But so folks, go to that company if you want that savings account. But I do have that as one of my savings accounts. But what I want to also show is now we want to show how you can use the infinite banking process. And one of the really easy examples is buying a car, because we all have to buy cars. And so I want to model that now. So we are going to get a car. We're going to get a $30,000 car, and we're going to save we're going to delay buying it for a few years to save up enough money to afford it. So in year 4, we're going to get our first car. And over the life of 30 years, we're going to get 6 cars, and we're going to pay these cars back within 4 years. And then we are going to, in this example, we're going to go to the bank and get a loan. And currently at PenFed, the loan rate for a car is 4.79%. And so we're going to get charged 4.79%. And since it's a bank loan, they are forcing us to pay it back. That's what this loan payback rate means, is the bank, since you're getting it from a bank, you have to pay the interest, the principal and the interest back over a fixed period of time. And that's what that line represents, is we're paying it back at that rate, principal and interest.
Mm-hmm.
And it's a market loan, so that at the end of 30 years, and this was actually one of the moments when I had my epiphany, was I realized after 30 years, I have that same $411,000.51. And it just kind of struck me like, why are they exactly the same? And the reason is because I was being an honest banker. I was being forced by the bank to be an honest banker. And what that means is you pay that your dollars that you use, they have a cost. So there is a cost to borrowing this money from the bank, and that's the interest rate they're charging me. But there's also a contract, which means I have to pay it back. So it forces me to be an honest banker. So I'm still saving that $10,000 a year, just like I always was. But I'm paying, and I'm getting a loan from the bank, so it's not affecting the compound growth of my 10,000 a year, because I'm getting the money from the bank, but I have to pay it back. And so by being an honest banker, I still have that $411,000 at the end of 30 years, but I also have 6 cars. So that's a good thing.
Right.
And then you might say, well, I've been told you always want to pay cash because you don't want to lose that cost of interest. You want to save on the interest that you'd be giving to the mean banker for his money. So you want to pay cash. Okay, so let's model with that. And this is what really shocked me too when I went through this, and we'll see if it shocks you as well. but we're going to pay cash for this. And so what that means is we are not going to pay this back, and we don't care about the loan rate because we're paying cash. And we now every 4 years we put our $10,000 in the bank account at 2.8%, and every 4 years we take out $30,000 to buy our car. And at the end of 30 years, you will have $158,476 and six cars.
Whoa.
And so that was like, yeah, that was a whoa moment for me. So I'm way worse off paying cash for my cars. I should have just went to the bank. And I started asking myself, well, why is that? Why am I so worse off? And the answer is I wasn't being an honest banker. I was stealing the peas, as Nelson would say in his book, Becoming Your Own Banker. And what that means is I did not value my own money as much as I valued the banker's money.
That's right.
I took $30,000 out of my personal account, my money. I bought a car, but I did not pay it back. Where if I get a loan from a bank, I have to pay it back. It forces me to be an honest banker. And when I was dealing with my own money, I didn't value my money as much as I valued the bank's money. So I didn't pay it back. And that's the cost of not being an honest banker. That's a cost of stealing the peas.
Mm-hmm.
And that was really a big epiphany to me because it can be any savings vehicle, coffee can, savings account, anything. If you don't pay it back with interest, and that whole idea, it's called economic value add. Every dollar has a cost. So if you don't value the cost of your dollars, then you're going to get 158,000 at the end of 30 years instead of 411,000. And so that was kind of the main key. I haven't even talked about early cash value whole life insurance yet. And already it's clear that what Nelson was talking about don't steal the peas, is so important. Value your own money as much as you value the banker's money. Pay yourself back at bare minimum with interest, and you will come out ahead. And so if we show what that looks like, if you're being an honest banker paying yourself back, you'll see the difference here. You'll now have $28,000 because you saved, since you're paying yourself back and you're valuing your own dollars, and you did not pay that interest out to the banker over those 30 years. You saved that 17,586 went back to your family. So that's what valuing your own dollars looks like more than the bankers. You'll come out ahead. But then what will really, I think, blow you away as well? What if I worked with the Family Banking Show team with Derek and John and Rob, and they helped me create an early cash value whole life insurance policy for myself where I put that same $10,000 a year, instead of putting it into a savings account, I put it into an early cash value whole life insurance policy. What would that look like?
Sure.
And so what we'll do now is we'll load up that policy, and we will change this to account loan. And the policy has with the insurance company that this is from, is they have their cost of their interest rate on a policy loan is 5.3%. So we need to put that in. There's also this is actually a direct recognition company. So you get a little less growth on the loans that you have out. So that's represented by that 0.65.
Yeah.
And we're going to pay it back. We're going to be an honest banker. We're going to pay it back at 5.3. But you'll notice it's 518,241. But you got to remember, one of the big differentiators about using your policy for your family banking system is it grows tax deferred. So there's no taxes on that growth. And you'll see that at the end of 30 years, if you borrowed against the cash value in your whole life policy, you will have $671,467 over 30 years versus 428. And the only reason And someone might say that's incredible, and it is incredible. And how is that possible? And the reason being is because of that the internal rate of return of the growth of your policy is better than 2.8%. It's a lot better than 2.8%. And the main reason is because it's growing tax deferred. You're not getting taxed on that growth. And the interest that you would have been paying back to the bank for borrowing money from them, that goes back in as profit, and the portion of that comes back to you as a dividend. So it's not only are you getting uninterrupted compound growth, you're getting the profitability of the insurance company because it's a mutually owned insurance company, and that's the only kind we recommend or write for. And so you're getting those profits back to you as dividends that are buying more death benefit, which provides more cash value. And so you get this exponential curve of growth. The internal rate of return is so much higher than you would get in a savings account. That's the difference. It's not magic. So there's two pieces. You're being an honest banker. You're not stealing the peas. You're paying it back with interest, just like you would if you were getting a loan, but then it's growing tax deferred because you have two pieces. You have don't steal the peas, but then the other piece is the product. The most efficient product, in our opinion, to do the infinite banking process is with early cash value dividend paying whole life insurance. And that is the difference right in front of you. And you get a death benefit. So it really shows what Nelson was talking about, the importance of don't steal the peas, and then you're making sure your savings vehicle is the most efficient one, which is your whole life policy. And I really think that summarizes it pretty well and proves out the infinite banking process and why it works.
That's pretty powerful. Wow. And I think the biggest kicker is where you pay all cash, like from your savings account,
Right.
and then just forget about it. You don't pay yourself back. I think that, like you're talking about, was the epiphany, the
Yep.
light bulb, where your 300K that you save over 30 years is actually 158 because you've just poured it into depreciating liabilities, basically in
Right.
cars, and losing it forever. Like,
Right.
or sure, you
But
got
that's
the
the
same
thing
car.
is, yeah, but that's the thing is like you're still, you're as if you were a cash buyer, you're like, I'm still putting that $10,000 a year in, right? I'm putting in 10K into my savings account, I'm putting 10K into my policy. We're both being good savers, right? The saving mechanism is the same. We're being good savers. But then when we go to actually purchase the things of life, we're not being honest bankers. We're stealing the peas.
You're right.
And that is what really shocked me when I saw that. And that's why Nelson says if you just don't steal the peas, you will be better off than your peers. If you can conquer the human problems and you can not steal the peas, you will be better than your peers just by doing that without finding some fancy, exotic rate of return in the market. If you just don't steal the peas, you will come out way ahead. And if you happen to now be aware of a product that gives you the most efficient way to not steal the peas, which is early cash value whole life insurance, it even accelerates that savings so far surpass your peers.
Right.
And that's the power of it. And it's so simple.
Yeah, I think one of the big key takeaways for me that I really like what you said, Rob, earlier is that we have to value our money as much as the bank does, if not more.
Right.
Like there's a clear value that the bank places on their capital. Why shouldn't
Hmm.
we be placing as much value on ours, if not more? And it really just
Yes.
comes down to that. And then, yeah, we found a saving strategy using life insurance that maximizes all these benefits that is the result, 671,000 as opposed to what, 300, 400,000
Hmm.
maybe on a good day. And,
Yeah.
there so much more variables in the traditional saving strategy of even getting that high yield savings for 30 years at 2.8%. That's not going to
Yeah.
happen. Having a consistent car loan at 4.79, that's not going to happen. You know, it's
Right.
it's crazy to think of, all the variables that could in fact impact the traditional savings method negatively. But yet we've mitigated so many of those variables by using life insurance as our saving strategy. Yeah, job well done. John, last comment here for our listeners.
Yeah, I was just going to say, not to mention, you are in control and the banker. Like you get to the whole time control when you repay the P's. So that if you
Yep.
do have negative cash flow in a certain season, so you have a seasonal business or sales cycle or bonus cycle, whatever it is, at least you have those provisions like earmarked to
Yep.
repay yourself in an honest fashion, keeping the peace and the peace of mind and the control that otherwise, if you were to go to get that bank loan, it would probably be a lot more stressful for the family to know that you're on the hook for that every single month, regardless of what's happening in your personal
Yep.
account. The kicker, even if I ended up with the same amount of dollars, which by the way, you end up with 260,000 more, like basically 50% more. Even if I had the same amount, I would still choose IBC because
Right.
I have control.
Yeah, the control, the guarantees. And then here's the other piece, John. What if the banker decides not to loan you the money in one of those years? Like, no, we're not going to give you the money. We're not going to loan you the money. But if you're going to the banker, they might not give you the loan.
That's right.
So it's all about, control and guarantees and that superior internal rate of return, uninterrupted compound growth.
Well, great episode, guys.
And the death benefit.
Yeah, you cannot miss out on that huge death benefit someday down the road, income tax free
Right.
to your beneficiaries. Like that's incredible that they add
And
on top.
And if you're in 80% of the states, they can't touch your money. They cannot touch your death benefit. So if you get sued, if you're in Minnesota, like we are, unfortunately, it's one of those 20% of the states where it's not fully protected. But if you get sued, they can come after your savings account for sure. But your whole life insurance cash value and death benefit are protected for the most part. So it's just like we keep going, why would you not do it?
Here comes Rob. Here comes angry Rob.
Yep, angry Rob. Passionate Rob.
All right, guys. Hey, great episode. Really hope our listeners appreciate this type of analysis. If there's numbers that you guys want to see us do, be sure to reach out to us at thefamilybankingshow@gmail.com, and we can show you firsthand experience, help walk us through these examples with you, and to see what your saving strategy and how to optimize it using the infinite banking concept. All right, guys. We will see you in the next episode.
Sounds good.
Thank you.
See you guys.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.